Hello, everyone. Welcome to Market Week in Review for the week ending May 23rd, 2025. My name is Bei-Chen Lin. I'm a senior investment strategist and head of Canadian strategy here at Russell Investments. Today, we'll be talking about three major topics. First, we'll talk about Canadian and UK inflation. Second, we'll talk about the flash PMIs. Finally, we'll wrap up with our discussion of some watch points for both equities and fixed income going forward. So let's get started. In terms of inflation, we got inflation data for both Canada and the United Kingdom, and in both markets, core inflation came in above consensus expectations. And although this was a bit of a setback, it is important to remember that when it comes to the central bank's inflation fight, this was never going to be a linear path. There was always inherently going to be some twists and turns along the way. But over the medium term, we do expect that both central banks will likely be able to bring inflation down to their 2% target, but it might take some time before inflation ultimately reaches that level. Now, in terms of the implications onto central bank actions, we did see in the aftermath of those reports, the markets were reducing their probabilities of rate cuts for the month of June for both the Bank of Canada and the Bank of England. However, even if those two central banks were to stay on hold in the month of June, we do think that more rate cuts this year are likely needed. For the Bank of England, we expect that over time, they will likely take interest rates down to a more neutral level. Meanwhile, in terms of the Bank of Canada, interest rates right now are probably already at that neutral level. However, we still expect that later this year, they'll need to do more rate cuts because when we think about the Canadian labor market, with the unemployment rate near 7%, the Canadian labor market is already quite fragile, and the risk of a recession in Canada is above average and is probably higher than the risk of a recession in the United States. And so against that backdrop, we do think that eventually the Bank of Canada will likely need to continue its rate cutting cycle, even if it doesn't cut rates this time around. Next, let's talk about flash PMIs. Flash PMIs are an example of a leading economic indicator, so these indicators give us some more insights about the state of economy ahead of the insights that we can glean from other economic indicators. And in terms of the U.S. flash PMIs, they pointed to signs of robustness and resilience in the U.S. economy. On both the manufacturing side and on the services side, we had a flash PMI that came in above 50, so it was in expansionary territory. However, when it comes to Europe, we saw a little bit of a different story there, where European flash PMIs overall were actually contractionary, driven by some softer than expected PMI data on the services side. Now, ultimately, in terms of our views on cyclical risks, we continue to think that the U.S. most likely is headed for a soft landing, but recession risks in the U.S. are still somewhat above average. Meanwhile, we expect that outside of the U.S., there might be higher cyclical risks than within the U.S. However, when it comes to relative equity market valuations, we continue to think that stocks in the U.S. are a little bit more expensive than stocks outside of the U.S. And so when you balance those two factors out, we think that maintaining a neutral asset allocation across regions is probably a more beneficial choice than making a big regional tactical bet at this point in time. And finally, we'll wrap up with a discussion of some of our watch points on both equities and fixed income. What we've seen is that the equity markets are now coming very close to their all-time highs in the U.S., with the S&P 500 trading around 5,800 to 5,900, so coming within striking distance of that all-time high. Meanwhile, on the fixed income side of things, we have seen bond yields move back up in the U.S., and one of the reasons for that move upward in bond yields is because there's been more questions around the U.S. budget bill and to what extent that budget bill might potentially add to the U.S. deficit. In terms of our views on both equities and bonds at the moment, though, we continue to be neutral on that risk-on, risk-off decision. We think that at this point in time, given the elevated macroeconomic uncertainty, staying close to that strategic asset allocation might still be the best course of action. It's also important to watch over the coming weeks as we get closer to the expiration of the 90-day pause on tariffs, to what extent we see more trade deals potentially get worked out between different nations. That's all for this week. Thanks for tuning in.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.